Great. So welcome everyone to this edition of the DueDash Investor Lounge. I'm Michael, one of the co-founders and CMO of DueDash, and looking forward to introducing you very briefly for you what DueDash is, what this is all about, and then we'll go to the main part of it, the session. Now, DueDash was started by a team of serial entrepreneurs investors with a clear goal, fixing what we see as the biggest issue in venture capital. A lot of startups don't really know how to build trust with investors and how to actually build the processes that are needed for that. So with DueDash, we created a platform to enable both startups and investors to go through the whole investment journey together, from sourcing over diligence up to portfolio management and updates, making sure that the trust building happens, a proper relationship is established and nurtured, and from where funding can happen. If you are not yet on DueDash, I would kindly ask you to please sign up and start your journey with us. I just see that some people kind of like unmuted. Just make sure to mute yourself if you just come in. Great. So if you're not yet on DueDash, just please come, sign up, try it out. And we're also happy to have one-on-one calls with you to show you more of the platform and how we can help you with your needs, might you be an investor or a startup. We are also supported by a lot of amazing partners, might it be software partners of your deals, credits, discounts, but also startup ecosystem organizations. So if you need any support here, let us know and we're happy to connect you as well. We usually also ask you to do a quick survey at the beginning of these sessions, just that we learn a bit more about you, what you're interested in, and where you might need support. So you can go onto this link. I will gonna share it in the chat in a second, or if you have a QR code reader on your smartphone, you can just scan this code in a second. Otherwise, after I finish here, I will just share the link as well into the chat. I'm going to be here in the session, so if you have any questions or know anything about DueDash, you can just write me a private message. Otherwise, I would give it now to Parul and Glenn. And what I'm already going to say now, if you already have questions or things that you want to ask during the session, you can already put them now in the chat. I'm going to collect all the questions so you can go through them later on. And with that, I would give it to you, Parul, but let me just put you on the spot so that people see you. Great. I'm moving myself out. To you, Parul.
Thank you, Michael. Good morning, good afternoon, good evening to everybody. I am the founder and CEO of DueDash, an investor relations platform that makes startup investable and saves investors time and money by enabling startups to share standardized information covering the entire process and creating value in the process. I'm a serial entrepreneur. I've built multi-million-dollar companies, invested privately in companies as well for more than 15 years, experience with M&A, so basically the entire shebang. And I'm really thrilled here today to introduce Glenn from Quake Capital, who is the founder and general partner at Quake Capital. He invests in really early stage companies across verticals, be it fintech, logistics, clean tech, across US and also internationally. Very few of those venture funds do that. Glenn himself is a seasoned entrepreneur, fund manager, and active angel investor with over 3 decades of experience. As a CEO and founder for more than 9 successful companies, he's generated over $5 billion worth of investor returns. His expertise in software and hardware is unmatchable, including enterprise solutions, and Glenn is amazing at forging strategic partnerships with industry giants like Apple, Microsoft, or Visa. Thank you so much, Glenn, for joining us today. I would like you to share your journey that led you to become an investor and explain us why startup investing is so personal for you. It's really, really important factor in your life. And as an industry agnostic investor, what triggers you to make that investment decisions? What checks and balances do you look for when you go forward and write that check?
Sure, a lot to cover there. So like you mentioned, I was a long time founder, so 25 years. I actually launched a total of 14 companies, exited 9, so that means I had 5 pretty abysmal failures along the way. But I saw early on the impact that innovation, but particularly early stage innovation, can have on the people in your company, but also the world at large. And I had some very big early wins, very big IPO back in 1998, 99, that transformed my life and the lives of all the people around me, all the employees I was working with. And from that, I kind of immediately, the next thing you do is you start becoming an investor. It's just a natural progression. And I ended up doing hundreds of venture investments myself over the next 20 plus years. And through that process, I think, I ended up focusing, that became almost my children, because I didn't end up having, my wife and I didn't have kids. So, why I do this, how I do this, a lot of it's just sort of tied to the way my life has evolved, and my desire to drive innovation in the world. And those two things together really kind of sync up nicely. In terms of what I look for, being that industry agnostic investor, I would say big markets, bold ideas, good people. Those are just obvious big concepts. Real great. That's not really helpful. The main thing, though, is we look for companies that are probably past their first pivot, because one of the things that I think most of the founders on this call have already figured out, and all of the investors certainly, is that every startup pivots. And that first major pivot is a point of failure. A lot of companies fail to navigate it, about 25%, in fact. And so we want to invest after that first pivot to get rid of that, mitigate that risk. But we also believe that that pivot really proves a lot of things. It proves generally product market fit, that the audience wants your product. It's usually a point at which the audience kind of figures out how to use your product. It might not be the way you expected. And so that's generally a really big learning point in the company. And it also gives us a real good sense of whether that leadership team has the ability to navigate. The last thing I would say is that we tend to focus, and you know this well, Parul, we tend to focus on metrics and merit over everything else. We want to remove as much bias as we can from our investment investigation and due diligence. And so by focusing on the real objective data as opposed to our subjective bias, we're able to make much better decisions. So we're really digging in when we look at a company. We want to like the people. We want to like the, feel that they're trustworthy and authentic and all these things, but we're really, really digging into the data of the company.
Awesome. I think you already answered my next question with respect to your thesis, because you invest across the sector and how you go about that process. So I think that's already well covered. So in your role, I just say you probably, help people cross the bridge between the traditional investors and startups, and you potentially assess a lot of digital landscape, knowing Quake pretty well as an insider myself. And you're continuously evaluating big opportunities which can transform business spaces, potentially provide scalability further to where they are. And you mentioned about the founders, and you try to dig deeper onto that. But other than that, what kind of data points, what kind of evidences or factors that you potentially prioritize when making those investment decisions, where you identify the potential for success? Because Quake is one of the top 2% of the funds in the world, and in early stage investments with really a good track record on exits, as well as the amount of failures that it has is really, really very low.
Yeah, that's a really good point. And probably one of the things I should have said at the top, just so people have a sense of what we do. Across our various portfolios, we have about 275 investments. I think one of the things that I'm most proud of with respect to our founders is the survival rate. It's really, really hard for a startup, obviously, again, as you all know, to just make it through the first 3, 4, 5 years. A typical 5-year survival rate in a venture fund would be around 40-45%. Ours is about 90%, meaning that our startups are incredibly stable. And even in this really complicated environment the last few years, they've been able to thrive. So I think that's an important point when we get to those factors that we look at. But before we do that, let's talk about the bridge builder component. That's probably more important now than ever. I think the ability to have good partners, and again, I have a tendency, folks, to switch into kind of founder mode, because that I really was a founder first, long before as a venture capitalist. And I tend to take that approach with our startups. So I think right now as a founder, it's really, really important the partners that you get. Generally speaking, I can recall my days raising money early stage, in the earliest days of my companies, and you'll often take money wherever you can get it, because that's just the reality. It's difficult. And especially in a market like this, you don't necessarily have a ton of choices. But whenever you can, it's really important to focus on the partners that you're working with, particularly with respect to capital. Can they come back and can they help you? Can they make the introductions you need? I think investors that can add value are really like a rocket fuel on the company. If you can find those that can be very active, very engaged, not just give you a check. It's not, used to be, we would say smart money. That's not really, I think that's important. That's kind of what you would think of as people that can give you strategic guidance. There are lots of people out there that can give you pretty good strategic guidance. I don't want to undersell it, but there are probably a lot of people in your existing networks that can do that. What you really need are people that can be very active, almost like an additional hand inside of your company, providing not just support, but basically opening up their networks, making sales calls on your behalf, that sort of stuff. If you can find early investors like that, it will definitely separate you from those companies that don't have it. So I think that's how my point here is not so much, yes, you can try and achieve that, but our goal as a fund is to be that. So I think that's how we've attacked it, Parul, from the beginning. We knew that these founders were going to need help. I think there are a lot of really good early stage funds that try and do this. I think it's more important than ever, though, right now. I mean, we really need, and frankly, we're seeing a lot of mid-stage funds that either are not able to or are not simply doing, are not stepping up to do this right now. So yeah, I think it is more important probably than ever to pick the right partners. In terms of what we look for to identify success or potential future success, the obvious one's revenue, right? So everybody always talks about that, but we also look at partnerships, distribution deals, pilots. Grants are great. I'm not the biggest fan of grants, but they're a great way of extending runway. They can be good ways to validate the technology for sales into certain markets, education, government, health, military. So those can be interesting things. Key team hires. Have you hired the right people? Like are really good people seeing something in your company that makes them want to leave their existing situation or try something new? Those are pretty good signals as well. The one I want to tell founders to be careful of, because I don't think that they recognize this, I see it time and again in pitch decks. Be very careful with advisors in your advisory boards. And I just told you how important it is to have, these people that can help and be strategic. So I want to be clear what I'm talking about here. There's a balance. If you bring in really, really fascinating people, really established, proven people on your advisory board, and they're not investors, that raises a question. Now, I've been on many of those boards, and there's been many situations where I didn't invest because it wasn't quite yet the time for me to invest based on the criteria I use and a variety of things over history, the way I approach startups. So I understand why an advisor might not invest in you. I want you to understand what a VC sees when they see that slide. They may not see the same thing you see. So you have to be careful. It's a balance between what these people bring to the table and how they appear on your, basically on your presentation, on your pitch deck. So be prepared for that question. Be prepared to hopefully diffuse it before you even get there, but understand that there is some question when you see somebody like that. Wait a minute, why don't they just fund this thing? So I think that from our perspective, we look at a lot of those types of things, probably downgrading advisory over all the other stuff that I mentioned.
Yeah, that's very important piece of advice. So Glenn, I know Quake has their own model of assessing companies. At DueDash, you're well aware of that. We have a 5T model: the team, timing, traction, technology, and TAM to assess startups. What filters do you use to analyze companies, and what factors contribute to founders' success? Because you are industry agnostic, I would ask you across industries.
Yeah, I mean, you know how strongly I feel about that. So we've always, you guys use the 5Ts. We've always very similarly, we were, and in this order: traction, team, technology, or product.
Mhm.
And people were often, I think a lot of venture funds just, I want to be careful, because I think when founders are out there talking to other venture funds, I think the most common priority or organization of that is team or founder first, then product, and honestly, then traction. So we do it very different than most teams that are out there. And it's important to know when you're pitching, what do they prioritize? Okay. And I think a lot of venture, when you get right down to it, is who you know, where you worked, where you went to school, where you live, like those things that are absolutely useless. And that's not my opinion. That's Startup Genome Report, looking at thousands of startups every single year, have shown that none of those things matter. But that's where most venture funds focus. And so understanding that when you go in to talk to them is important. If that's what they care about, if they care that you worked at Cisco before, or they care that you live in their backyard, or they care that you went to a certain school, those are important things to know. Some you can fix, some you can't fix. In our case, we focus on metrics, and because it removes bias primarily. We wanted to make sure that every deal that we attacked, when we were looking at the due diligence and really digging in there, we wanted to make sure that we weren't bringing bias from the rest of our life into that room when we were doing that. When we get down to the traits that are, like you mentioned, team, we try and look at things that are, or any of those elements that are more subjective. We try and look at things like flexibility, awareness, presence, professionalism. Let me explain what I mean, because those are just big terms, right? So flexibility, we view this as a long-term partnership. We're going to be working with this founder for probably 7 or 8 years. So we need, and flexibility is ridiculously important to navigate some of the pivots that are going to happen. If you're inflexible, you won't navigate any of them. So you have to have some flexibility. That doesn't mean violating your original vision or mission. It just simply means understanding that the audience, the market, things are moving in directions that maybe you didn't anticipate. You're not that good. None of us are that good. We can't have all the answers until there's an old thing and adage in the military. Every battle plan survives until first contact with the enemy. Well, in this case, every good business plan survives until first contact with its customers. And then you're going to have to adjust. So flexibility is incredibly important. And it also shows a certain level of maturity in the founder. And the next piece is awareness. And what I'm talking about there is having an understanding, feedback loops, interaction with your customers, awareness of things within your business. So having an awareness of potential founder fights, which kill about 12% of all companies, having an awareness of maybe features that are unused, but are still causing you to have to support, which is a huge problem in the focus in the business. So things like that. Presence. I hate getting into a meeting with somebody and having them focused on their phone, or, you really need to be present in the moment you're in. It's incredibly important that you are 100% into the meeting. I know we all like to multitask. I know, but none of us are honestly very good at it. So be in the moment. That whatever you're doing that moment needs to be important enough to command your attention. Otherwise, have somebody else do it, or don't do it at all. And if it's that important, then you should be 100% in on it. I've never been in, and I've been in multi-billion-dollar deals, and I've never been in a meeting where I couldn't, just focus on that meeting. I wasn't going to lose a deal in 5 minutes. It's never happened to me. Honestly, I've never lost a deal in a day. I know others who have, but it's pretty uncommon. Final thing is just, being professional. If you're thinking of this from a VC's perspective, we're going to be introducing you to our network. You got to take your time, get it right. Don't slap off emails without thinking them through. Don't misspell people's names. It's the one thing on an email they'll actually read. The rest they might not, but they're going to get their name. So there's just a lot of little stuff like that that I see over and over again that a lot of founders get wrong. So we're pretty focused on that. I'm not going to not invest somebody because they screw up an email. I'm just simply saying that these are the things we look for. They certainly understand most VCs are looking for a reason to say no. That sounds terrible, but we're looking at hundreds to thousands of deals a month. So it's much, much more important to say no than it is to say yes. So those are just some of the things that we're typically looking for when we put it together.
Thanks. That's like a lot of pieces out there, a lot of golden nuggets out there for people. I'm going to dive deeper into the traction piece that you said. We always hear that timing is crucial for company success. So what factors contribute to customer adoption and growth for companies? And in your experience, I mean, you've built businesses yourself, you've been like out there for more than 3 decades now. What are some of the common challenges the companies face? And if you could share some key best practices for founders. Of course, you've shared some pieces with respect to their behavior and their fluidity and being aware and being present, but just building that company, just making sure that the business can fly. What would be those key best practices in your point of view?
Wow. That's a lot to unpack, but let's see where we can go with this. So the first thing is still goes back to that notion I had before about a pivot. So you start off, when you build a startup, you start off with an idea. Ultimately, you might even have an idea about what your customers might want. Maybe it's your own problem, like Slack effectively was built solving their own problem and then realized that some other people had the same problem. So you might have a pretty good idea what your customers or lookalikes to you might want. But usually I'd say about 98% of the time, I mean, it's a very high 90% of the time you're off. Maybe it's a little, maybe it's a lot, but this is where that first pivot comes in. That's why I get so hung up on that, because it's almost always tied to that really specific moment when you realize that your customers are using the product maybe in a way you didn't anticipate. Maybe it's some novel, unexpected way. Maybe it's they're actually incorporating other things along with your product to make it more powerful. But you're going to learn that they're doing something different with it. And it's how you adapt to that. Do you lean into it? I see a lot of founders fight it. They're like, somehow their customer is wrong. Your customer is not wrong. Maybe you have the wrong customer, but the customer is using the product. They see it in the way that is most helpful to them. So you can either lean into that, go find a new audience, or fight the audience that's not good. If you're trying to train your audience, that's a really generally not a good business model. So that make or break moment is really important in the life cycle of a startup. Recognizing it, leaning into it, or adapting to it. Fighting it's pretty much never the right answer. Some other things that I would say that, what is it contributes to the success of a startup? My God, I have a list of about, 40 things that I go through with our startups, but I would say, and there's a good write-up I did on LinkedIn. Well, I think it's a good write-up. I used to do hobby racing. I used to race cars, and one of the things there's a lot of lessons that you learn in that world that are really applicable to the startup world. And one of the sayings that I like is the car goes where the eyes are. So whatever you're looking at is where the car is going to end up. If you're looking at the wall, you're going to end up in the wall. And it's basically a car, the hands go where the eyes are, the car goes where the hands go. So it's pretty much what you would expect. When you walk into the office, back when we had offices, or when you get on a Zoom call every morning, what are you talking about? What do your employees think is important? They're going to think what's important is whatever you're talking about first every morning. What metric are you focused on first when you talk to your employees? That should align with what your biggest mission is, your biggest strategy is. If it doesn't, you're creating conflict and confusion inside your ranks. So the team will focus on what the leader believes and emotes as being the most important thing right away. Like the first thing they talk about, the thing they talk about the most. So that's critically important. I would say other basic things: hire slow, fire fast. If you get the wrong person in an early stage company, they're like a cancer inside the business. They can really kill it from the inside, and they can do so quickly. So really be purposeful about the people you bring into your company. And if they are not a good fit, and I'm sorry if this sounds bad, but again, these are organic, the startups like an organic being almost that you're creating. It's growing, and you're going to kill it if you bring in the wrong people. So you have to treat it like a pet or like an entity that you're raising. And so be very purposeful about the people that you bring in its orbit, and get rid of the ones that are toxic, and get rid of them immediately. So hire over weeks or months, fire over days or hours. Focus, like militantly focus. Don't add a bunch of features to your product. You cannot troubleshoot 30 things at once. You need to add a single thing, be able to tell what it's doing and interacting, how it's interacting with your customer, and then adapt from that. So there's an old adage about, do something till you absolutely nail it before you move on. There are very good reasons for that. I could spend an hour talking about product development, but focus. And I would say that generally speaking, a lot of, kind of this on all fronts, and it's sort of related to that focus, aim small, miss small, small incremental changes, small areas of, again, going back to what I said at the very beginning, when you walk into the room, what's the first thing that you talk about? Everything should be in small bites. Your vision should be huge, but your tactical day-to-day attack should be very, very focused and tied to very small movements within the business. Things that you can create accountability loops around. You can't create accountability loops around massive system process. You can do it around specific interactions within the system. You can't create customer feedback loops from 40 features, but you can create them and understand how your customers are reacting with one feature or two maybe. So you want to do everything you do at this stage incrementally, and very well understand it before you move on to the next small thing. And I see a lot of founders get that wrong because they want to boil the ocean right away.
Yeah, this is a masterclass founding one-on-one. So thank you so much, Glenn, for reminding us all of that. I would like to move on to the next question. With the current economic landscape, we've observed about 39% increase in the average time it takes between the funding rounds within just 9 months. How do you see it has affected, and how are you evaluating the valuation, especially for the early stage? And are there specific indicators out there with respect to business model or revenue models or any other hypothesis that you look for to identify a repeatable business model, something which is sustainable? I would really love to have your insight on that, and what are the challenges and opportunities that startups are encountering in this environment?
Yeah, I mean, it's definitely a situation where valuations are down, and let's face it, most VCs, and I say most VCs, are like mostly human, at least until our generative AI overlords take over. And most humans like a deal. So I would tell founders right now to expect a negotiation. Now, having said that, I'm not seeing too much of that in early stage. I'm not saying it doesn't exist. You and I were talking earlier about international markets versus the US markets, and it's certainly worse outside of the US. But where we're really seeing big valuation drops is in the B, C, D round teams that have, and if you think about it, this makes a lot of sense. They have much higher burn rates, much bigger staffs, which are tied to that, of course. They're looking for much bigger checks when they're out raising capital. and you've got a limited pool of institutional investors that are trying to shore up their portfolios. So they're going to pick and choose the best stuff they have because it puts a lot of pressure on those VCs. One thing, as the B, C, D, E round teams are dropping valuations, the challenge with that is they drop down into the next class. So B round teams then are competing against A round teams. So eventually this does trickle down and get to early stage. And again, I'm not suggesting it's not happening to early stage, but it's not near as big a deal. Now, let's talk about why it's not near as big a deal. It's not near as big a deal for early stage because early stage has a number of superpowers that it can lean into here. So most early stage investors have much lower expectations for revenue growth. Growth is a little different, but there's still many early stage teams are in R&D. So when you're focused there, even if you've got some sales, your investors and the world around you for future rounds are a little bit more understanding. You have a much lower burn than an A, B, C, D round team. I think one of the biggest things you got going for you is less specialization. What I see, I love running a company in this environment. That may not be a popular comment, but I personally, this is when I would thrive because you can close the gap on later stage teams so much easier. They're laying off specialized talent and they long ago forgot how to be generalist. So they now don't know how to function in many cases. Most early stage teams are kind of those Renaissance units where they can do all the different jobs. And should you want to hire really good specialized people, there's going to be a lot in the market. So you're going to be able to hire great talent. But right now you have the ability to do a lot of different things with a team that was designed to do it all. Whereas those greater, bigger teams now have lost entire chunks of their company that were specialized. Many times they don't even know how to contact their customers. So key areas that really get hit hard in the bigger companies are sales and customer support. So it's a really good time, not to mention product development, but that's probably not really slowing the company very much. Sales and customer support are definitely slowing those big companies. So you have some startup superpowers, and I would lean into those where you can. In terms of there's industries that are going to get hit, and there's industries that are not going to get hit as bad. And I hear a lot, I'm talking to a lot of VCs about that on a regular basis. I'm on calls with them all the time. This is less of an issue for us. I'll talk about it briefly just so that everybody kind of understands, but I don't want founders, when I say like, okay, what industries are not really resistant to inflation and recession? Which ones are going to be most impacted, in other words? That's going to be the ones that involve a lot of discretionary spending, typically consumer spending. So that would be travel, hospitality, retail, some luxury goods, not all luxury goods. So now let me pause. I don't want every founder in those spaces that I just mentioned are probably a little bit more impacted to freak out. I could care less. There are a lot of venture funds out there that believe strongly in the need for a diversified portfolio. I'm one of them. So from our perspective, we're going to balance our portfolio at all times. Those industries might be down now, but they're not going to be down forever. And they'll have a really nice bounce back when they come. And they're probably a pretty good valuation right now. So we're going to pepper our portfolio with good and bad, technically, industries, what people are perceiving as technically good or bad industries right now. A lot of funds, though, again, this is know your venture fund, right? When you go to talk to them, you need to understand how they feel about this stuff. And I think that there are a lot of funds that'll avoid those industries, just to be aware. Other industries that are really recession and inflation resistant include those that are like healthcare, some technology. And I would say that that's a bigger conversation. Certain government programs fall under that. But I would say generally anything that increases workplace efficiency can be a good industry as well, because companies are going to be looking to cut costs. So things that are going to improve efficiency, increase sales, that are necessary spends, those are going to be things that are obviously a little bit easier to sell right now.
Awesome. So how do you actively source these deals for early stage startup investments? I'm sure like a lot of companies just reach out to you on LinkedIn or on Quake directly. Other than that, how do you source the deals?
It's a ton. I mean, it's a lot, right? Understand that VCs are getting buried. From our perspective, we started working, Parul, we started working with you a couple years ago now, a few years ago now, and really watched the DueDash platform evolve. And just people on this call don't know, but we're basically moving our diligence completely, or not our diligence necessarily, but our platforming of diligence and you're going to be augmenting our diligence, but we're going to be utilizing the DueDash platform for all of our deal sourcing. That's going to be happening. We've been migrating to that. It'll take some time for that to be done completely, but there's a huge difference in the ability to. So again, you kind of need to understand the workflow of the VC. So from our perspective, we do over 390 universities that we work with, where we get inbound applications. We get deals through a lot of the founder platforms you guys already know. We do direct outreach. We built our own little AI bot that goes and looks for proof of traction in the market and then emails those founders to come and apply to us. And then we get a ton of cold emails. And that last one's the toughest one. So where I see platform like DueDash coming in is that we can start to have more of a one-on-one kind of dialogue. It's still kind of a cold email, but there's a lot of data attached to that cold email. It's incredibly difficult to send someone like me an email and get us to dig deeper into your business model. And it's not a function of not liking it's something I know you like to dig into, Parul. It's the notion of you've only got about 20 or 30 seconds to catch my attention because I'm getting hundreds of emails a day. And that's not just me, that's everybody on the team. And most of those emails are from startups. So you have to figure out how can you break through. And one of the things that a platform like DueDash does, some of these other platforms do, is the ability for you to effectively identify those funds that are really a good fit for you. It's kind of, again, this knowing your audience is incredibly important. I get so many emails from funds that are too late stage for us. That I get emails from teams that are really nowhere near. They're an idea. They're what I would call ideation. We don't do either of those things. No, I'm sorry if you're on this call and we're hoping to reach out but it would be a waste of your time, and it's not going to be any particularly effective for our time either. You have to find the funds if you're an ideation play, pre-revenue, pre-MVP, or maybe just near MVP. You have to find those funds that do that. Most of those are frankly super angels, friends and family, but there are some funds that exist to do that. They're very limited. If you're pre-A, but you're much further along than what I would consider late seed or just really at A, and you're raising a $5 million round, we're not your story either. So I think the most important thing when you're sending an email or connecting with somebody is something like that. In terms of like, how we're going to change, I think that these technologies are getting to the point where very few venture funds are going to do this the way they historically have, which is to just take email inbound. That's what most funds do. It's not what we do, but that's what most funds do. I think now most funds are moving to software solutions where they've got systems that'll do some part of the due diligence, part of the sourcing. So a lot of times, I think when you guys are sending stuff across the wall in the next 6 to 12 months, it's probably not even hardly interacting with a human. I think that's going to be a pretty significant change in the space.
Yeah. I mean, this is an important point because in the current climate, especially, when evaluating a company, do you look for a certain period of runway that they potentially have? And do you also see early stage startups actively build relationships with investors to generate interest in their upcoming funding rounds?
Well, that's critical. So yes, first of all, extend your runway, raise more, no question. We were telling our teams a year ago to get 18 months, and we probably undershot it a little bit. So most of our teams went out in February, March, April of last year, raised much bigger rounds than they might have otherwise planned on, so that instead of having 9 to 12 months runway, they were looking at 18 months runway. So we're still advising teams to get, now I do think the market, I'm a little more bullish on the market than I was 4 or 5 months ago. But I mean, I still would tell teams to build a bigger runway. The other thing is, you're not raising, I think there's this really big mistake that a lot of founders make, which is that I'm out raising today. No, you're really, what you do today is about a raise that you're going to do 9 to 12 months from now. What you do on this round now will determine what your next round looks like. Your valuation, who you're talking to, when you have to go into market, all of that's determined now. That's not determined 9 months from now or 12 months from now. It's determined with this round. Okay. So I think that a lot of founders really need to build those relationships. Looking at our 275 investments, looking at the founders who've been successful, they're the ones who have really good updates, regular transparency, reaching out to potential investors, and as well as those of us who've already invested, trying to get those people, shepherd them along and get them comfortable for their next round, as they determine that somebody is a pretty interesting potential investor. They're trying to move them into the ecosystem, connecting them with other investors, drawing them into some of their strategy conversations where they can, in part to get them moved towards being a real investor, but also in part to, again, I said, this is a long relationship. So they want to know, the founder wants to know if they're going to have a good relationship with this party as well. So bringing them into that dialogue. Now, that's a delicate balance. I have other founders that let's just say, push that envelope too far. And, so you don't want to be too pushy there. You don't want to, they've got a life, they've got other real investments they're already doing. They're only going to want to be so engaged in your business. It's your life. It's your baby. It's not theirs yet. So I think you have to balance that, but it's a really good practice to build that relationship 9 months ahead of time. And by the way, I'll say something else. If you raise money from somebody, it's phenomenal to me how many startups do this. If you raise some money from someone and then you don't talk to them for 9 months and then come back to them with your hat, with looking for capital, hat in hand, looking for capital at the last minute, that's a very awkward conversation. On the flip side, if you've been talking to them every few weeks for the last 9 months, or in our case, most of our teams we're talking to every week, every other week, then it's a very easy conversation to have. And they've been preparing. A lot of times the fund can actually set aside capital and have the ability to do that. Whereas if you come to us last minute, we're like, I've had a lot of teams this month do it. And I was like, look, I just doled out all this money over the last 4 months to about a dozen other teams, existing teams. Had you been on my list, I might have made room for you, but I don't have that right now. I have to open and close fund 4, that would be our next fund, in order for me to give you capital. And so it's just a matter of understanding and keeping that dialogue and always keeping those fires warm, keep them burning. Don't just ignore them. That's a horrible thing. And then Parul, sorry to do this. One other real quick comment, just because you probably have some founders looking at crowdfunding. There's something happened with crowdfunding I didn't anticipate that I've been talking about a little bit lately. So with crowdfunding, a lot of times what will happen is you've got, well, it's not a lot of times, it's all the time. You might have 1 or 2 institutions who get involved in the crowdfunding. You're talking to them separately and you ask them to enter your crowdfunding campaign. Generally speaking, it's going to be a lot of smaller checks. Now, here's where it becomes a problem. I'm a fan of crowdfunding, don't get me wrong. I just want founders to understand a weakness in it so that you can shore it up. What happens is when we come into a situation like this, where capital is scarce, and you have to go back and hit up investors to get you through a difficult period, maybe make a bridge loan to the company, something like that. There's nowhere to go in crowdfunding. Like there's hundreds of people in your deal, but none of them can write the check for you. You need to balance your investor profile if you can, even if you do crowdfunding, I would encourage you to have a couple institutional investors that can step up when need be. We've got a very good company right now going through this. We're like the only one of two institutional investors, and they've got probably, I don't even know, maybe thousands. They've raised millions on crowdfunding, and they need a bridge, and there's nowhere to go. So the burden's falling on just a couple funds, and Quake itself is not really designed to do large follow-on checks. We're designed to do, we do multiple checks. Just to give you guys a sense, our first check is generally 150. We go up to $1 million. Our typical goal is to go to about 500,000 on what we consider to be our better deals in follow-on. So that's not a situation where we can carry a company. So again, just having an awareness of how these different systems work. Just be careful if you do that one. If you go with crowdfunding, I think it's great. We're friends with a ton of the platforms. I love what they do. I love the way it's opened up the market, but just be aware that there's a downside to that as well if you just have too much of it.
Yeah, I think that's a great add-on. And I was going to ask you that question. In fact, was my follow-on question to your previous comment, because I mean, I know you are a data-driven investor, and that's the premise of DueDash as a data-driven platform, investor relations, all-in-one do-it-yourself tool for streamlining investor engagement for startups, helping them to save time with data rooms, investor updates, and sourcing, and all-in-one visualized dashboards and one-on-one access control as well. Startups engage with investors through reporting, direct messaging, and also providing continuous updates where investors can potentially track them, and they can track the communication and contacts and pipeline boards, the entire shebang. And they can create and upload their own contacts, expand their outreach beyond what we have, which is their company profiles and easily. And for investors like yourselves, it's a complete
Parul, I think
sorry.
we lost you. We lost you a little bit there.
Okay, so for investors, it's a complete ecosystem for deal flow to portfolio management. So for all users out here, you can set up your profile as a startup or investor to supercharge your engagement. So Glenn, I think what I would like to do now is ask you really quick questions so that you can answer in short sentences, maybe 1 or 2 sentences. I'd be happy to start that whenever you're ready.
Yeah, and before I do that, just real quick on the DueDash platform, so that I didn't really dig into that, and I think probably a lot of people would be like, well, are you just giving a plug to DueDash? I want to be really clear. We're moving all of our portfolio companies over there. It's taken a while for the platform to get to the point where it is now, but I've never seen anything like it. And I'm not just look, I'm not just saying that. I think if I was a founder right now, I'd absolutely be using it. As a VC, I'm absolutely using it. I've recommended it to multiple other VCs. I'm going to continue to do that. The ability, what you guys can't see on your end, is what I can do on the back end with this thing. The ability to filter deals, the ability to have my team communicate about the deals in the background, score them independently so we're not polluting each other's results, then share and collaborate on those, then filter down again from that so that we're continually looking at fewer and fewer deals, again, sorting down. The ability to do that, the ability then to email and communicate and share data securely through a data room, but a very specific data room with the founders. These are just things that don't exist. They're not on F6S, they're not on Gus, they're not on Angel. There's nothing like it that I've seen. So that's not meant to be, it is a plug, but it really wasn't meant to be a plug. That is just, I think that there is an opportunity for platforms like DueDash, and I haven't seen any like it yet, but I think that that's the future of how we do this business. I do think that's the case. And I'm ready for quick fire questions if that's where you want to go.
Thank you, Glenn. I appreciate that. Thank you so much. So, I mean, we know investors are busy people. A great 1-minute introduction. What elements should it contain when somebody's talking to an investor like yourself?
I always tell our founders it's all about proof. Whatever it is you're presenting, it's your product proof. Customers want it, product market fit. It's your market proof. It's a big market. It's your proof you're a good person with credibility. So it's basically proof, credibility. The other thing is authenticity. I need to believe, I think a lot of times if it's just overpitched, you'll hear a lot of investors say this, that it's just too, and I know it's a balance, but if you're authentic to yourself, to your vision, to your ideal, it'll generally come off as being, very real.
What's your take on generative AI?
Well, everybody's jumping on the bandwagon. I think that obviously it's the talk. There's a lot of money being poured into it. I'm much more interested in what it's going to do for startups. And there's a ton of stuff there, by the way. I think it's going to create more superpower for startups because a lot of things that are really expensive right now, like customer support is, the ability to do, online chat, for example, it's a barrier for smaller companies against bigger companies, or it has been. It's not anymore. Content, iStock, Shutterstock, B-roll video, that stuff's expensive. Not anymore. So a lot of things, I think, for when I look at generative AI, I see it as creating huge innovative boosts for early stage teams. I could go on and on. There's 6 or 7 areas where I think it's going to massively change the way that startups, data analytics. I'm a data scientist. It's an arcane art that only a few of us really understand. Not anymore. So how you understand your customers, how they're using your product, how you understand the market trends, those things that were typically done by consulting firms or, big organizations, not anymore.
So what are some of the latest trends and technology that you're watching and feel strongly about other than generative AI?
Well, that's the one primarily. I mean, we're paying attention, but I would say obviously money's pouring in. And again, you and I have talked about this. Money's pouring into climate, diversity, generative AI. Those are the areas that there's a lot of focus around. Now, we come at that a little bit differently. We're a generalist fund. And so I think all those buckets are really interesting. Those 3 things I mentioned are interesting to me, but in a much more generalist viewpoint. So I mentioned, generative AI is going to create, okay, let's take a quick step back. If you look at Uber, it couldn't exist without instant messaging or text messaging and GPS and a variety of other things. So when you create these platform tools, they then unlock entirely new industries. So I think generative AI is going to do that. And we're really trying to look at, much like I was just talking about chatbots, and I'll give you another one, localization. It's really hard to take your product and localize it for another language in another continent, on another continent. That barrier has just dropped dramatically. So I think that we're looking at that stuff in generative climate tech. That crosses almost every industry. And it's the interesting thing about climate, real quick, it's got major barriers to entry. It's not easy to do most climate. It's not just simple basic software. It's not social media, not to take away from it. But the benefit of those types of things is that they're very easy to launch. Climate stuff's very hard to launch. The benefit of something hard to launch, like hardware, or in this case, climate technologies, tend to be that they're very difficult to fight against. They're really good barriers once you're there. So for us, Parul, we're kind of looking at those types of things that are these big buckets and applying them across broader industry spectrum, if that makes sense.
Sure. Thank you. Share one of the craziest idea that was ever pitched to you.
It's everything about sex. It's really the case. So I don't want to pick on any failed ideas. So I'm going to pick on some successful stuff. But I mean, we've seen sex toy rentals, sex toy recycling, fetish dating apps. I mean, every niche you can imagine in the sex world has been pitched to us over the years. And surprisingly, many of those have done quite well. The weirdest one we have is a breast milk distribution company working predominantly here in the United States. And they've created technology that creates an organic powdered breast milk formula. Basically, it's powdered breast milk. And they're doing about $1 million a month and are probably going to end up being a multi-billion-dollar company ultimately. So yeah, some crazy stuff out there, but I don't like picking on the failed stuff. It's hard enough as a startup.
Sure.
So those are some of the good ones.
Awesome. So Glenn, we do have people who invest in companies or would like to invest, get onto the journey in audience time to time. So why should people consider venture capital as a space or startups as an alternative investment space, investing in the companies or even as a VC fund? What kind of process they can go through and why should they consider, and what would be your advice for them to get started on that journey?
Well, now's a great time. I mean, it's easy for me to say because I'm in it, but I would say that now is, excuse me, one second. My startups are waking up here in the United States. Generally, when you've got a down market, that's like the best time. You're going to have more talent, like I mentioned earlier, entering the market, but you're also going to have a lot of that talent going off and starting their own startups. So I think you're now in this situation where realistically valuations are quite good, teams are really strong, opportunities like we just talked about, climate, generative AI, there's a lot of platform plays that are coming in now. So I think now is a really good time to invest. I think it really, how you do it is tricky. I've obviously done, personally hundreds of startup investments, and then through Quake, another few hundred startup investments. I think that it all comes down to how much money you have to deploy generally. And it's easy for me to say because I run a fund, but I'm a bigger fan of a fund investment than I am direct startup investments until you understand how this all works. You really need to have a diversified portfolio. You need to have check discipline. So you're not writing a $25,000 check here and a $200,000 check there. That is a horrible way to do startup investing. If you get that wrong, you'll crater your portfolio. So I think lock in with a really good fund manager, spend 6 months to a year understanding how they're going about it. And then if you can, now again, some of those funds have, minimums that make it difficult, but there are syndicates out there. There are other things you can join, maybe an angel organization, but basically spend some time watching and understanding before you deploy, and then deploy it with check discipline. That would be the biggest thing I would say.
What qualities value the most in professional relationship?
So I think it sort of depends on the relation, inside my own companies for leadership, I look for consistency. That's really how you drive accountability. But key elements beyond that for me are honesty. I really value follow through. I really get frustrated. Again, these relationships are long-term. So any trait that ties into partnership is really important to me. But I would say, and I mentioned earlier, being present, really being in the moment. There's a lot to that. Much better decision making happens there. And I think there's a lot of really bad traits that we've evolved into over the last 15 years or so that take us away from that presence and really, really do not serve us well.
So who was your childhood inspiration?
We didn't have Gates and Jobs and Elon and Thiel and like those guys. I mean, well, we had them. I was right there with those guys at XCOM and PayPal. I knew those guys when I was in the Valley, but we didn't have those as children. So for me, it was astronauts and explorers. And I later in life had a really great opportunity. I had dinner with Buzz Aldrin, and I realized, and I was already a pretty successful entrepreneur at that point, and I realized how similar. I'm not comparing myself to an astronaut. I'm saying their mindset though is really, really powerful and along the same lines of the way we need to be thinking. They really are pushing the boundaries, exploring, innovating. That's really pretty much where those guys live.
What drives you when you get up in the morning?
Yeah. Well, again, I don't have, this is my legacy. I don't have children. So my startups and the innovation they bring to the world is really, really my legacy. So I guess that would be it. It's terrible to say, but I almost, I almost don't have time to think about that. Maybe that's a bad answer,
and you're
but
already
it's the reality.
motivated. You're motivated all through and through. What are you currently reading?
Oh, I'm always a big reader. I've always got 5 or 6 books that I'm reading. And usually there's a couple business books in there. One quick thing I'll say about that is that I've long used a service. In my case, it's SoundView, but there's a ton of companies out there that do these summaries of business books, because I don't have time to read every business book. And there's only usually a few chapters that are even really that relevant to me. So I'll use a service like that to give me the summaries, and then I'll go buy the books that actually fit. There's a couple I'm reading right now. So I'm revisiting Creativity Inc. Don't ask me who did it. It's one of the guys from Pixar, but it's a really good book on team building and foundation building for your business. I just started Profit First. I don't have enough of a read yet to give you much of a summary on it, but it seems like it'd be a really good basis for where we are in the economy right now. It basically talks about how you can streamline your expenses, cut costs, focus on bringing profit into the business. Those all seem like really good themes right now, but I just started it literally like 2 days ago.
Awesome. So if there was a one piece of advice that you had to give to young Glenn, what would that advice be?
Spend more time on the journey, like appreciating the journey. I've told all my founders this. Good or bad, the clock keeps running. You don't get a chance to go through this. You're only going to have a few of these in you. I was incredibly blessed to have a bunch of them. Often I sometimes couldn't tell what the good ones were from the bad ones. So just be aware of that and
Awesome.
enjoy it as much as you can.
Yeah, I think I hear that from you all the time. So thanks for that reminder.
You'll remember it. You know, for those of you that are younger, 30 years from now, it'll mean something. Right now, you're just so busy, you almost can't think about it. But I'm telling you, it's precious time.
Yeah. So I'm going to take some of the audience questions. Some people had to jump out, but I'll anyway go ahead and ask questions that people have asked here. I think one of the clarification a founder is asking is that I think when you mentioned when you get involved is
I can't hear you, Parul. Sorry, you just broke up. Michael, can you see the question?
So wait, Parul. Yeah, when you're back now. Yeah.
Okay, fine. So I think the question was that I think when you mentioned that we get involved after the first pivot. So the question was that does Quake get involved only after the first shock or the failure?
So we're not really looking for success or failure at that point. We're trying to see, we believe that there's certain tells, that there are certain indicators of when that pivot has happened. They're usually tied to a certain degree of customer growth or revenue, month over month growth of a certain rate over a certain number of months. Now, I'm not giving those to you here because if I do, I'll end up getting an email tomorrow from, a bunch of founders that fit that criteria exactly. And it's something that we don't really publish, but I will say that what we're looking for is evidence of a particular rate of growth. And again, that can be revenue based, but it could also be based on the number of customers that are using the platform. That can also be tied to, but it's harder for us to get there on levels of engagement, time on of usage. It can be on distribution partnerships. We've done a deal before where somebody landed just one single distributor, but that distributor had so many customers, had already run a pilot program. We were able to extrapolate what the likelihood that pilot metrics would translate into their larger audience. So I wouldn't say there's any one thing that drives us to say, okay, that's it. But we do have criteria that we're looking at to see if the company has experienced the kind of growth that indicates that they're past that first challenge point where a lot of teams fail.
So I think the subsequent question from the same person is that as a pre-seed or seed company, they may not have a lot of traction. So what would be expected from them when they are providing that information to Quake or any other fund who's investing in early stage companies? What kind of key data points they can provide them to make them interested in investing in them?
Well, again, you kind of have to know the fund. You can't really change the fund's charter. Okay, so when I go out and I raise money from my investors, I tell them what we're going to invest in, and it's a really specific criteria. I can't deviate from that. So, again, we don't do ideation, we don't do pre-revenue. I mean, it's unusual for us. We'll do pre-revenue if we think it's very close, but it has to be very, very close to revenue. And again, we can't change that. So I think the priority becomes not so much trying to get me to adapt my thesis to your message or your message to hook me. You really need to find the audience that is inclined to look at that deal. We work with funds that are pre-revenue funds, that are ideation funds. Those are going to look at those deals. We look at funds or work with funds and co-invest with funds that do A rounds. But we don't do those. I mean, we'll do them in our existing deals, but we don't do them for first checks. I think it's really, really important. And again, that's where some of these platforms will come into play, like DueDash. You really, really need to understand. And if you go to their site, you should be able to get a pretty good idea. They're going to more or less lay out their charter somewhere on their website. They should anyway, what they invest in.
I think there are a couple of questions on those lines, because one of the founders is asking any tips on learning key factors to interest investors or funds on one side, and the other person is asking, how do you differentiate when it's early stage, specifically when should you approach a VC, when you're bootstrapping or you have some revenues already in place? Like, how to know that you're not too early or you're not too late, I guess. So I think they are in the similar line, but different points that people are asking for.
Well, and they triggered something in me too, between those various questions, all the different ones put together. I'll give you guys my take. I think a nugget that I used, and I think what I've seen as a VC. Personally, if I get a referral from one of our founders, from one of our startup founders, which are way easier for you to approach than to approach me, if I get a referral from one of our founders, it's way more meaningful to me than if I get a referral from a venture fund. I'm not saying every VC is like that, but I know a lot that are. My founders mean way more to me than some other random venture fund out there. We just happen to be in the same industry, but I'm not connected to those people at the same level I am my founders. And so I would encourage you guys are already going to events and meetups and, online things, and you're meeting with founders. Connect with those founders. Find, if you find founders that are already in funds and they like their investors. Now, granted, there's this dynamic where founders sometimes are a little reluctant to make introductions to people who invest in them out of fear that maybe it takes money out of their pocket. It doesn't really work that way, but there's this fear that maybe it does. But if you can build relationships with founders and they'll make a referral for you, that's an incredibly good way to get into a fund. And those founders are going to know exactly what that fund likes, doesn't like, what worked in their meetings and all that. You guys are all good at dissecting all that stuff. So I would say that's probably the best way to learn about a fund. Next good way to learn about a fund is to catch a founder like this on a call or panel or whatever, talking about the fund. And then of course the websites, you can go to LinkedIn and the VC's actual website and some of these things, but those are always canned. And to be honest, like I didn't write our website, somebody else did. So I'm not sure. I couldn't even tell you necessarily what's on there. I mean, I have a general idea, but I didn't write the copy.
Sure. So I think that's a great piece of advice. Network with other founders, try to learn from their experience and their network as well. And potentially they can put in a good word or make the intro for you as well.
I take 100% of the meetings presented by our founders. 100%. That's pretty good hit ratio.
Yeah. So I think one of the questions was about the current investment climate and what are the drivers for it, and whether and by when is it going to change in your point of view?
There's a lot of things on the horizon that we have to watch for. Commercial real estate is scary. I think the banking stuff was worrisome, but a lot less so now here in the United States, but that would have caused problems internationally. So will the commercial real estate crisis in the US if it expands. If that happens, that'll be latter part of this year. I would say generally speaking, we've been seeing here, you and I were talking that funding is down for early stage internationally, but in the United States, it was actually still up in the first quarter. We've been seeing a thaw coming off. Most of our teams have been able to get, again, these are revenue teams with pretty good metrics, but our teams have been able to raise. So I feel pretty good about this summer. I think some of the later stage is still going to be a train wreck through the end of the year. Maybe even longer, but I think early stage, it kind of comes down to we've got, I don't want to be super negative, but you have a lot of different military concerns worldwide, not just Ukraine and Russia. There are issues outside of that we have to worry about. Then you've got, economic stability in different markets that could trigger bigger stuff around the world. And then, like I mentioned, commercial real estate crisis that could really it's much bigger than the housing crisis was here in the United States. So I think that there are some things, another shoe could drop, but from our perspective, we're feeling pretty good about about things starting to move the right direction.
Thank you, Glenn, so much. It's been awesome having you. And I know you are on DueDash platform. But when founders reach out to you, what should they consider? We've provided a template. They can put 5T inputs, top 3 inputs to you. If there's anything that you want to say, last, golden advice, last great words from you.
I was just, it's funny to me. We were just talking about banking, and I'm just going to say, kind of read the room, know your audience. So, sharing stuff on DueDash is pretty, I don't think there's much of an issue there, but I can tell you that right after Silicon Valley Bank failed on a Sunday, I got 50 founders email me on Monday asking for a meeting to discuss funding. That was a bad day to send any VC a note asking for capital. There were regulators had just come in and taken over the bank. We didn't know what was going to happen next. That was a really, really one of those situations where I was surprised. And I think it was sort of a sorting mechanism. It's like, my gosh, did they not understand? Many on this call might be like, well, that's really harsh. Well, again, I'm looking at 1,000 deals. I'm trying to figure out why I can say no. And so, and as bad as that may sound, that's really the world I live in. And so that all VCs frankly live in. There's at least 2 times, there's so much more deals than there is even dry powder right now. There's so much more need than there is capital. So I just think that you have to really be conscious of when you send a note. By the way, I would probably not send anything on Friday. I get a ton of stuff from founders on Friday. I don't know why. I'm working on Friday. I work all weekend, but I don't think that that's necessarily a good time. That's usually, if I'm looking at calendar, that's usually when I'm trying to get prepped for the next week. It's Friday through Sunday. It's usually when I'm trying to get ready. So I just would say, kind of try and get a sense for workflows and what's going on in the world. Don't send something when there's such a major news cycle that everybody's mind is off of it.
Thank you. I know you will be able to find some amazing startups on DueDash, and I'm really looking forward to your engagement there. I know you check it, and I know the founders have heard from you today what you're looking for. And the guys who are still here, if you liked it, then please share it and follow DueDash and follow Glenn on LinkedIn as well. Thank you so much, everybody, those who joined. Have a great day ahead, and looking forward for you to join DueDash as well. Thank you.
Thanks, everybody. Take care.